Okay, good afternoon, everybody, and welcome to Gary's Traders Group. This is your host, Gary Humeski. It is Monday, November the 10th, a little after 4 p.m. Eastern Standard Time. As always, these webinars are for education purposes only. I'm not giving any trading advice whatsoever. Trading does involve risk. Okay, let's get out of that. And let's go to the macro picture. Everybody see the screen okay? Somebody give me a yeah. They can see the screen and audio and the visuals okay? All right. Good. Okay, we reached a new high today, again, on the Dow as well as the S&P. Which are still in a very, very strong bullish trend. However, with the NASDAQ, I'm going to change this because these are Heiken Ash candles, which really just visually are able to show whether it's bullish or bearish, but it doesn't really give you the candlestick patterns recognition like a regular candlestick would. So I want to change this just quickly on the NASDAQ so you guys can see something I wanted to point out here that's important. You see how there's a gap up right here? This is, first of all, a very classic V pattern that you can see right here. This is very, very classic in stock or indice movement, bouncing and coming up. Now, anybody who studies candlesticks a little bit, which gives you the same, candlesticks as far as the high, low, open, and close give you the same thing as price bars. The difference being is candlesticks will give you a sentiment of the market and what it's doing and what it could potentially do. This looks like a bullish flag. Like this could be a flag right here. And if this was the pole, which consolidation is happening. The only other thing this possibly could be is what's called an island reversal. Whenever you get a gap up like this and then price trends within a certain range, then there's a possibility that it could gap back down below the close of the candle before the gap up. I don't think that's what this is. I think the market is taking a pause and taking a breather from some very, very bullish moves, and over the last 2-3 weeks, we've really gone from a low. We've almost gained 2,000 points in the Dow. From 15,855 all the way up to 17,618. So that's nearly 2,000 points in a relatively short period of time. So I believe this is not an island reversal, but again, keep in mind that we do have a turned over hull here and a DPO that's now come within the Bollinger Bands. Now I could put some moving averages on here, which you guys can do on your own. If you go to a regular just charting program, whatever you use. For example, I did it on the SPYs here, and I wanted to show this to you to show the potential of where there, if this was a, not on the SPYs, I'm sorry, the COMP. Well, if there was going to be reversal, let me stay here. If it would be, it would come down to about 198, thereabouts, right in here. So one of the plays, folks, you could do this week, because I think this is going to pull back a little bit and then continue its run, is do a credit spread on the SPYs with November's expiration. And I think this week ahead may and should bring a pause, but then continue its run into Thanksgiving, into the end of the year. So, if you position yourself with a spread in the SPYs with the November expiration, it may give you some decent returns. All you have to watch out for, is when volume comes back, because volume is going to be the leading indicator. You can, put volume on a subgraph or any place. I have different things that I use to be able to gauge what the volume is, because volume will come in, and then if it does, then the market's going to take off again. So you could make some decent money by selling some puts out of the money, and of course protect yourself by buying one strike further out. So that's a strategy that I may do this week to make a little bit of money for this week. The other thing I wanted to show is a very similar pattern on several different indices. I haven't done this, but on a macro picture, I'm going to start doing this. I'm going to start using the indice ETFs to give correlations. Like the SPY would be one. The next would be the IWM, which is the Russell. My apologies. Okay, any time now? I don't know why it's being delayed. Should be quite quick. I don't know why. It's the Russell ETF. Why am I not getting information on this? Brian, it was a put, not a call, a put spread. Puts, when it comes to spreads in general, or verticals as they're called, I don't know why the Russell is not pulling up. I have no clue. Let's look at the Qs. I don't understand why I'm not getting data for any of this stuff. The diamonds. Well, all right, if that's the way it's going to be. How about gold? GOD, at least that pops up. Something I did notice. There was a bounce that we had here, and I've been waiting for gold to pull up. I've been talking about it, and it hasn't done it. It just keeps being beat down. But this may have bottomed out here, and this may be a turnaround. We'll see. We'll see. Again, what I'll look for is volume, to pull up again. If you look at the miners, the GDX, the same thing happened. I just don't understand why I'm not pulling data for any of this stuff. It's really weird. Silver should pop up, SLV. Huh. You know what? This is really weird. I don't understand this. I'm not even getting Apple, folks. So, and I'm getting, why am I getting delayed data here? You see that? This should be real time. And everything's getting delayed. You know what? I'm going to close out of Thinkorswim real quick. And I am going to reopen it. So I apologize. All my stuff is on paper money, so I'm going to have to stay on that. Okay, hopefully this solved the problem. Yeah, there it goes. It's real-time data now. I don't know why I was saying delayed. Something must have happened. Hopefully IWM will pull up there. Okay, so everything's back to normal. See, same thing that I was trying to show you on the NASDAQ is happening in the Russell. The V pattern, a gap, bullish flag, or possibly an island reversal. An island reversal. I don't think it is. I think this is just a pause in the market. So the two, on the, you see on the NASDAQ and the Russell, you see this pattern. On the SPYs, you don't. See, it continues to be bullish. And the diamonds is the same way. It continues to be bullish. So the two that you could play a credit spread on this week, selling the puts, would be probably the diamonds or the SPYs out of the money. Okay, using November's expiration. The dollar is up. And that's probably due to the currency crisis in the world, and it's going to continue to have strength. The treasuries are down. So we see that inverse relationship between the dollar and the treasuries. And the last thing I wanted to show is about gold. Remember, I brought up gold, and this may be, well, see, now I have a reversal signal. So I don't know if this is a turnaround. I do see the hull hasn't changed. It's a pretty powerful indicator, but it can also, do some head fakes depending on what price moves. So normally you need some other correlation, and that would be the PPS or a breakout of the tweaked Bollinger Bands or the detrending price oscillator. I don't see that. The other thing is with silver, I don't see anything positive yet, or volume either. Now, if silver volume picks up, gold volume picks up, the miners again had the same kind of breakout off of a bottom, and I see some good volume picking up here, right? Of course, you don't know if that's negative or positive, so you'd have to look at the candlesticks a little bit more closely to see what they are, or another indicator if you know some other indicators of what positive or negative volume is. See, we had, and usually positive volume is going to precede movement. So we've had some big positive volume here. It's just a pullback, so it's possible this thing could break out. Again, you could throw on some moving averages. I've used the 5 EMA crossing the 20 EMA as a trigger sometimes, and that's a nice early trigger along with the bottoming out of linear regression and some other breakouts. So these are things that you can kind of experiment with, and this is pulled. If you put a 5 EMA on here, it's very close, and you'll see a leashing effect where price will move away from the average, then come back, away and come back. Generally, it hovers right around it, but a 5 EMA crossing a 20 EMA is a good trigger to indicate that it's time to make the trade. Okay, so I talked about doing some put credit spreads on the SPY and the IWM. I'm sorry, on the SPY and the diamonds, because they're very bullish. In the sheet I'm going to send you is a lot of stuff. I did a lot of homework for you guys. I do also subscribe to other things like several people on this call do. And then, Bob, I always appreciate the stuff that you email me. And one of the things I did do, I hate saying I did do, it just doesn't sound right. I did do. Let me bring this over so you guys can see it. Did a lot of calendar spreads, and not only did I look for strikes, but I also put price. But you see how there's an asterisk, and again, this asterisk dictates this right here. All prices are as of Friday's close, so things change. Now, did it change a lot? That's not the one I wanted to bring up. Watch list. Not a lot, folks. There was a pretty good gain on the NASDAQ, but all in all, it's kind of a pause day, if you will. And if anything, there's going to be a little bit of retracement this week. So that's kind of what I expect, and that's why I'm saying selling some put spreads on the bullish trending of the SPYs and the diamonds is a nice way to make a little bit of money in a short period of time here. And that's part of what these sessions are all about is, you know, how can we take advantage of current market situations and make some money. So anyways, you guys can look more at these for those people that are interested, and I did look at prices. I also put down the premium spreads. Now, what does premium spread mean? It's the spread between selling the front month and buying the further out month, which is what creates a calendar spread. So it's the spread between what somebody is willing to pay in premium for the 90 strike in November and what you would pay for buying time buying the same strike. And that the difference between the premium for January and November, or vice versa, between November and January, is what premium spread is. You get that from two places. And Bob, this is going to shock you. I thought the only place, and it's a great tool that Pete put in, is our own option chain. Because he took the premium and annualized it, right? Well, let's get the right month here. There's 12 days. This is a weekly. Annualized. That means to the people for the 18.5 strike level on the TLT. Well, you know what? Let's use something else. Let's use an example off of this. That's a big spread here. GPRE. Let's use GPRE, the biggest spread I found. That doesn't look right. Okay, that looks better. I know this chart looks a little bit different than what you guys are used to. I was experimenting with some other things like Bollinger Bands and so forth. I also see this, again, almost a bullish flag forming right here for this Green Plains Renewable Energy, you know, bouncing, you know, again, nice. It's not a classic V, but you can see there's a V here bouncing off the bottom. And as you see, there's a 520 EMA as a crossover. That's the red line here crossing the blue line. And then I've got a regular 50 SMA and 200. So I've got some bullish stuff happening here, even though for shorter term there may be a possibility it's going to pull back a little bit more and staying in this trading zone, you know. And again, though, when do you want to trade? You know, one of the things I learned about Bollinger Bands, this is real simple. If all you ever did is put Bollinger Bands on and a 5 and 20 EMA, boy, you could trade. And I think linear regression is important as well. Either that or use an RSI or a CCI, and, you know, don't use the standard 70-30 settings on an RSI. I would bring it up to 80-20. Matter of fact, that's what the default is for best choices, which is pretty interesting. You know, if you look at the default, they are 80-20, which is not the norm. The norm is 70-30. They just stretched it out a little bit more. And this is all it's really telling you is relative strength index. It's telling you is something overbought or oversold. You know, is it time to, you know, look at you know, depending if you're just doing directionally buying puts or if it's oversold buying calls. So whatever you use, but one of the techniques on Bollinger Bands is when the bands start to squeeze, there's going to be a breakout happening. When they're real wide, that's not when you want to trade, you know. You want to trade when they're narrow like this right in here, and then you can play that. But when, you know, they start to pull away from the top band and break the bottom or top band, then you can go. It's a bearish move. That coupled with overbought, it's a real nice way to trade. Anyways, going to GPRE, back to what I was talking about, which was this 65.08 premium spread, which is a lot of money you could make in basically 3 weeks. So when you go to the option chain, what Peter did is he put in the annualization. Now remember, there's other things you got to look at besides that, because that could say, oh my gosh, somebody's willing to pay 100% premium on, you know, for 35 strike level. Well, yeah. Now, the other thing you got to be careful of, though, is make sure you've got open interest enough so it creates liquidity. If you don't have enough open interest, then it's not, even though it may be overpriced for buying that spot month and the premium is high, it's still not going to be a good trade for you because you won't have any buyers or sellers on the other side. So that's 100 here. Now, if you look at March's for the same strike level of 35, that premium is only 32. So that difference between the 32 and the 100 is what creates the premium spread. Okay? 35, 35, November, March. A little pricey, $2.90. I don't know what it did today. I'll pull back a little bit today, so it may not be as expensive. So in essence, what you're doing, folks, and this is something you all should do because it can generate a consistent flow of income, is to do these credit spreads. And you can find these stocks by simply creating a list on Best Choice, and then you have to individually go one through one. But what I have also learned is that if anybody is with Thinkorswim, I've learned of something that I don't know if it's a secret, I just played with it until I found out that it's almost exactly what I'm looking for. Is, you know how you can change the layouts? You use this little arrow here in the bottom and you just go to custom. And here's all the available items that you can add to your layout. So, you know, you're looking at things that you want to look at that helps you make a decision and reaffirm it, or perhaps give you caution to not do it. One of the ones I looked at is covered return. When Pete first taught me of how he does calendar spreads and what he looks for, he said it is the closest to doing a covered call as you can without owning the security. And I realized that's what that is. So it's telling me what the potential return is going to be. So if you look at GPRE and you look at 79.91, it's not as let me go back and close this out and go to March, and go to the 35s. You have a spread here from 79.91 to 31.14. So even if you weren't using Best Choice, which is giving you more accurately the annualized premium versus as if you own the stock and you sold a call against it. That's what a covered call is. The option is going to have some more premium involved in it. But it is a technique you can use whenever you're looking at a stock and you just happen to be strictly on Thinkorswim and you happen to run against one. If you have this as part of your layout, it can really show you, you know, wow, this is pretty overpriced here in the spot month. And boy, if I go out and buy some time, and all you do is you buy that further out month and then hold the control key. So you see how it changes all of this when I'm holding the control key? And keep holding it, and then you sell the front month. So it's still 290, which is what I put. So that hasn't changed. But you're able to capture that spread between here and here. In all reality, it's a lot higher because Best Choice is actually calculated the annualized. And the difference between 100 and 32 is over 65%. Okay? Hopefully that will show you some things. So anyways, I wanted to go over one of those, but I've done the homework on all the ones that I looked at, and you should probably create these calendar spreads as far as a list goes about every couple of weeks. I mean, unless the market's really changing. If the market's really changing, then you should probably create them weekly, and you should be able to find some good trades to create income. Now, obviously, you can't do that many. You want to be able to reap the benefit. Now, one of the things that one of our traders does, Bob, successfully, and it's a good plan, you just got to be on top of things, is when you do these calendar spreads, if the trade for whatever reason goes against you, like, ideally what this would happen here with this GPRE is if you sold this November, now you're selling a call. So what do you want the stock to do? Do you want it to go up, or do you want it to go down when you're selling the call? I want it to go down, because then you're going to capture all that money that you sold it for, and you're going to pocket it. And that call that you sold is going to become worthless at expiration because you're taking advantage of time decay. This is playing the time decay game rather than the intrinsic value game, which is more the directional, verticals, those kind of things. That's the intrinsic game that we play. So the key that you want is you want that thing to go down and be able to capture all that money. Hey, guys, we got 12 days to expiration. I wouldn't mind making 65% of my money. I don't know about you guys. But let's just say the trade goes against you, right? Well, what you can do is sell the leg, i.e. the November, you buy it back and keep holding the March, right? Because the Marches will appreciate because the stock is going up instead of down, which is what you ideally want. Remember, I always say in my comment section, always try to trade the pullback from being oversold on a 6-month linear regression. So ideally, I'd want to have played, taken advantage. I wish I could have taken advantage of all of that on GPRE, because I'd sell a call, expire worthless, sell a call, expire worthless, sell a call, and then I just keep rolling from month to month. But that, this kind of thing is not really the way you want to ideally trade, because this has got a lot of there's a good spread between the low band and the high band, and you really don't want to trade a lot of stocks that have this kind of spread. Now, if I go to a year, it's still, you see it's skewed here, and see the linear regression lines are skewed because of this huge pullback. You could maybe see it better on just a straight linear regression. You want narrow bands when you want to do counter spreads. So I want to go through how do you find these things. Okay, I'm going to go back to saying what happens if the trade goes against you. One of the things you could do is sell that front leg that you're going to lose money on, right? Because the stock is going up, and you don't really want to be called out on, where you have to deliver the stock, and somebody's going to say, I'm going to exercise my right. You sold it to me for $1 at 35, and now the stock is 39, or 40. It's really just taken off, and the person, that 35 now, if you wanted to buy it, is going to cost $4, $5, hypothetically. And you sold it at 2, well, you don't want to be called out and have to deliver it. If you do, you're always protected, folks. You just have to sell your further out enough to be able to deliver that. That's all. The one that you bought further out, because you are protecting whenever you buy or sell on an option. You protect yourself. That's what verticals are. You're limiting profit, but you also limit risk that way too. So that's a strategy. Is if the trade goes against you, sell that front leg, buy that front leg back that you sold, let your other leg run, that further out leg, because it's going to continue to appreciate. That's your anchor. And then come back in and buy it for cheaper. if that makes sense. Okay? So let's go over how you find these kind of stocks. There it is. I found 45. And then I'm going to show you something else called peaks and valleys that I was playing with on Best Choice. Pretty neat. I found kind of a technique to be able to find some really volatile stocks, but right now let's just sort it by symbol. And there's GPRE. How do you find it? Well, you just simply go to the wizard, add the primary basics. You want to first click on options of, last traded within the last number of days, and bring the top bar all the way down. It will eliminate stocks that have not been traded in the last from 0 to 116 days out of the database. It just means those stocks have either stopped trading, been bought out, went out of business, whatever. I mean, most of them haven't gone out of business, but they've either merged or been bought out. They still happen to be in the database. So you want to bring that bar all the way down. Next, bring the current stock price up. I have been using like right under $30. You're always looking here, like there. And then I'm bringing the average volume up to over 500,000. Some people want to bring it up to 1 million. That's fine. It just gives you less stocks to look at. 502. Okay, so that brings it down to 864 stocks. Then you're adding 2 other conditions. Your first condition is going to be earnings growth. You want to find stocks that are screaming in earnings. I'm generally using 1 year. I want stocks that are just exploding in earnings over the last, 4 quarters, that are just making hand over fist in money, which creates divergence between price and earnings, and that's what you want. So I'm going to add earnings growth rate for 1 year. Then I'm going to bring this bar up to at least 80%. 78.7, close enough. Brings me down to 99 stocks. The next I want to do to create narrow bands, it's the exact opposite of adding volatility. It's adding price consistency, so it's really consistent in its price movement. So look for price growth rate consistency 1 year, right there. Add that. Same thing, I want about 80% price consistency. That's not etched in stone. I mean, you could do 70, you could do 90. I haven't experimented. It's just how I've started to do things. Bring this down to under 80. There we go. Now I got 50 stocks, which as of Friday, or over the weekend, the 9th, which is Friday's close, I had 45. So there's 5 more that's meeting that criteria. And simply save it to a user list. I always like to date it. And then I'll just put calendar spreads as a name and save it. Now you will not run this list that you just created through and anybody watch my training tapes, the Queen, or the Witch, whatever you want to call her. Some people call her the Bad Witch. I don't know who told me that. But you're not going to run it through the cycle because you're not looking for repeating moves within the default setting of 14 to 28 days. This is to find swing trading stocks is what that's for. What you want to do is simply go to the list that you found or you created, and then you're going to go, and this is an arduous task, folks. I hate to tell you this, but you're going to go one by one through all of these, simply clicking on the option chain. And I'm going to work with Brett because I think there should be a pretty easy way to create a way on this option chain to sort through a list. You see, if I just highlighted that and then added the next chain, there's a bug that pops up. and it could freeze up the software. So the only way to be able to do it is you have to click on each symbol, then go to the option chain. Your eyes should first fall on this column, annualized. Either that or open interest. So I can immediately say no. There's 14 open interest, and it's annualized to 14. There's nothing. There's nothing there. It's not a tradable stock. So, and see, BCS has stopped working. Thank you very much. Sorry, folks. Okay, back in business. Oh, you know what happens is when you're going through this list, you're sorting it by symbol. For example, I went to the next one. Before you go to the option chain, so things don't screw up the way it just did, the reason it did is, look at the date down here, or the date up here. They don't have any data from 7/17 to 2014. So it can't pull up an option chain, and that's why it's going to shut down. So I don't know why this American Electric Power Company doesn't. I mean, you could try adding the puzzle piece and see if it'll download more data. It doesn't. So don't even bother. Just go to the next. Now, why do I have AIG at 7/17/14? That's weird. Okay, this I have the data, 11/7. I don't know why I didn't. Okay. So just look down and make sure you have current data. That's when you go to the option chain. You only go 24 what, Bob? You go 24 months, or you only have 24 stocks to look at? Answer that question. I'll answer you. AIG, we all know it, big company, right? Okay, now remember, be careful. This is the weeklies. Make sure you go to the monthlies. 28, not real exciting. Not unless January's is like under 5. You know, I want some good spread. And January's is 12, so what is that? 16%? I mean, a lot of volume, obviously, and, you know, so there's tremendous liquidity. A lot of people are buying that 55s, right? It doesn't mean you can't do this and make some money, folks. I just like a bigger spread. That's what I'm looking for. You know, and the other thing you could say is, you know, how much is this costing me either? Also, well, the 55s, first of all, and that's another thing, be careful. See, I looked at November and I assumed 28. No, because the strike is 54.5, whereas the 55 is only a 16% annualized, because that's what I'm looking at in January's. The increments, you see what I'm saying, have changed. So be careful with that. Okay, only 24 stocks, Bob. All right, I'll email you the criteria. I think what's happening is you're probably bringing up earnings consistency and earnings growth rate and price consistency above 80%. And I've got it just a little bit below. That actually creates a lot more trades to look at. And that's still very consistent if it's 78% versus 81 or 82. I mean, that little spread difference between earnings growth and price consistency will create a lot more stocks. So anyways, be careful, folks. Now, as you see, it's not worth my time. 16% versus a January, which is 12. Well, let's go out and buy some time. Let's go to May. Is it less? No. It's 55 is 10.52, whereas my spot month is 16. Forget it. It's not worth it. 6%. Next. Again, I don't know why this is happening to my software. for some reason all my data stops at 717. I may have to re-download because somehow when I close down, it defaulted me back to, let's see what this looks like. No, I still have all my defaults. Okay. Now see, that's another thing you want to do. After you've determined that this is a good spread. Now there's November, 26%, 627, it's okay. Let's see what April's is. You want to buy it, if you can, buy 6 months, folks, on these calendar spreads. You don't have to. You can, and a lot of them I did was January and November's, and just taking advantage of the bull run that we should have on a lot of stocks between now and the end, right? And just playing the pullback. That's what you're doing. See, this stock is way oversold right now, or overbought. The stock is way overbought. So you want to pull that, you want to sell a call right now. Pocket that money between now and expiration, which is 12 days, have it pull back. Whatever you sold it for becomes worthless. You pocket all that money. It reduces your total cost of buying that further out month, which because you're buying time on that, right? Again, this is a time value game. And so you're able to get into that for cheaper. Now, BCR, I don't know if I included that on mine. I did not. And STX, I looked at that, Bob, and I don't know. Okay, going back to making this determination, I'm sorry, I'm bouncing a little bit. 26%, 627, overbought. Let's see what spread I can make. 11. So the difference between 11 and 26 is 15%. 15% in 12 days. If it becomes cost effective, here's the way you could easily determine if it's cost effective. You're selling this, remember? You're selling the front month. That's $1.05 that you're going to collect. You always get the bid when you sell something. It's never the mark or the ask. So you're always going to get, so it's $1.05. But then I got to go out and I got to buy April's, right? Holy Toledo, I got to pay $7.90, subtract $1.05 from $7.90. That's $6.85 I'm paying. That's too rich for my blood. Furthermore, there's only 39 out in April. Well, I could say, is there something in January maybe? January, it's 14%. The difference between 14 and 28 is, what, 12%, right? That's between the annualized in January and the annual, oh, I'm sorry, it's only 20, yes, 26. So the difference between 26 and 14 is 12%. I'm pocketing $1.05, but what do I got to pay? $4.30? That's still rich. $3.25 is still rich for my blood. As you see, what I've done is I've gone through all of this mechanics of going through each one of these. That's part of what you guys like me to do and why you're here. And I've given you pretty much the best of the best. And I've already taken the premiums. So all you guys got to do is take a look at it, see what you're going to pay, and take advantage of the opportunity if you so choose to do it. Again, this is for educational purposes. Okay. I'm going to do a little bit more homework. I haven't filled all this stuff out. These are the symbols we should all be looking at for directional trades. This week, folks, we have all retail coming out. Macy's, Kohl's, and I don't trade the retail stocks. You know, I looked through, there it is, earnings. I looked through all 23 of these earnings coming out this week, and frankly, I didn't see anything that excited me. Okay, there's Nordstrom's is coming out, and Kohl's is coming out, and Macy's is coming out, and then we got the retail report that's coming out from the government. Now, that will also tell us, folks, one thing. The savings the consumer has been able to pocket due to the lower oil prices, and are we as consumers going out spending that money? And generally it's in retail because it's the buying season for Christmas. If that's the case, retail may end up doing good. Okay, and so there may be, you know, continued growth. Along those lines, one of the people, again, Bob, who's is a good trader. He's becoming a good trader. He's starting to learn how to become a good trader, which is very happy to see. I did the homework for you guys, and here's what he had shared with me, and I thought, hey, that's a pretty smart deduction about, again, because this is based on history, and I like that when there's repeating things. And basically it's saying the market's worst performing as of October 31st will underperform during the last 2 months. The best performing stocks from October 31st, in other words, year-to-date to October 31st, will outperform the market in the last 2 months, right? So what I did is I did that filter of performance, including volume and price and optionable and those kind of things that we can take a look at. And all you got to do is click there for the 100 best. It's all in a .cvs file that you can import into Best Choice if you want. Run it through the witch or the queen, whatever you want to call it. See if there's opportunities for you. Or at the same time, if it's worse performing, Brian, this goes to you when you asked me about the SPYs. Are you selling the for the credit spreads? Are you selling the puts or selling the calls to create the credit? You could do that on either one. I mean, generally most people will sell puts for credit spreads way out of the money. Okay? So anyways, that's all for here for you guys to look at. Also did a little homework, and these are some of the rules that I follow by. And I don't profess, folks, to be a guru. I don't profess to be a master trader. I do profess to be a master plagiarizer. That I'm very good at. And I absorb like a sponge, and I'm able to then, practice that in real life, and then it becomes mine, and that increases my trading skills. So this is things that a lot of this I do, and one of the things that I think is important when you're doing credit spreads is what is your profit target? Because, again, exit strategy is the biggest problem most people have. It's not so much getting in or finding trades. It's when do you get out? And do you get out too soon? Do you get out too late? If you get out too soon, the next time you run it longer, and then you find you lose more, and then you do it shorter, and then you don't make as much, and then you're playing this seesaw game, Thanks, Jerry, for that compliment. I appreciate it. Anyways, follow these rules, folks, all of these rules, okay? They're very, very good. All right, use only, when you do the calendar spread game, you only want to use at the money options. Why? Because if you go in the money or out of the money, it becomes a biased directional trade. So therefore, the security has to move in one of the other directions, depending on if the calendar spread is bullish or bearish. So, when you're at the money, you have the most opportunity, statistically and probability, 50-50 chance, and that's where you want to be at. A lot of people ask me, what if I buy at the money and a little bit out of the money, or vice versa? That creates a diagonal. That's a whole different ball game, okay? That does become more directionally biased. This is trying to play the ultimate probabilities in our favor, playing the time value game. Okay, so read through these. I included those and try to apply them. The last is I do subscribe to Zacks, and I included the 7 best stocks for the next 30 days according to their proprietary formula. And this is their little PDF file booklet that describes the fundamentals, the PE, the earnings, da-da-da-da-da-da-da. I didn't even take a look at, oh no, I did. AFF, X, BCC, DRII, GBX, GRUB, VAC, TCN. I rattle them off. They're all in there. Take a look at them. See if there's anything you guys like on those things. So I included that. There's one short if you guys are interested. NITIS, as I used to call it. Chinese company. Nice looking overbought right now, right? Sitting way up here. And seasonally, this puppy tanks. So you got seasonal probability, and you've got overbought on linear regression. Let's go to charts. See if there's any triggers. Hello. Make some quick money on that, folks. Van Tharp, who sells a lot of educational material when he's excellent, on trading psychology, which is 50% of all trading. Learning technical analysis and seasonality is all good, but you got to have your mind right. Kind of like in that movie with Paul Newman and Jackie Gleason. You got your mind right, Luke? You got to have your mind right. So really, your mind can only absorb and understand and process about 5 triggers, 5 indicators. And that's really, you have linear regression is 1, moving averages 2, Hull 3, PPS 4, MOBO 5. So when I look at this, I can instantly recognize what's going on. Then my eyes fall here, which is a whole separate graph, and I'm looking, is it up or down? Is it overbought, oversold? This thing works, this setup, folks, probably 80% of the time or greater. It's a very, very good setup. So, that coupled with what we all spent money on, or you guys did. I got it for free, haha. But I paid my dues, trust me. 6 years with Sonny. Hey, he's okay now, by the way. He's out of the hospital, so don't forget to discuss BCS's new show long-term option targets. Are you talking about this, Bob? And when you go to this icon here, is that what you're talking about? Okay, that's not new. It's been on Best Choice since the beginning. It's just you're discovering it, and they show this a lot at the shows. I don't use it. I mean, it's okay. It's great. It's, you want to use you can use all sorts of different time frames. I mean, 6 months, and this is really showing based on the last 6 months of price movement, right? High, low, open, close, and volume. It's taking all that in consideration because that is what is in our database, right? Price data, date, open, high, low, close, volume, including earnings. It's taking all that in consideration, and then it's projecting out puts at the various months, November, December, January. These are that are available, including all the way out to 2016. And where potentially that stock could be at, the middle line is always at the money, be it puts or calls. On the put side, the closest is in the money, the further out is out of the money. It's the same thing with the call side. This line, or that dot, if you will. And you know how when you put your cursor on any of these other icons, it'll highlight that particular, like here. See, if I put my cursor on that bar, I can look up at the top and I can see the exact amount. I said, well, why can't you do that with these plots? See, it doesn't show anything. And they never did it, which peed me off. I don't know why these dots are so off, but again, it's more of a visual representation of where the stock could be based on the trend, and where you could potentially buy options at. And you can, take your eyes off to the side and see where that's at, where the stock could potentially be at, be it in the money, out of the money. I'm sorry, at the money, out of the money, in the money. In the money, at the money, out of the money. Oh, thank you. I'm sorry, I don't read the chat box enough. I can't do it from here because it'll screw things up. I've got to go back to the linear regression. Thank you, Jose. I did not see that. So 2 years to here, now to 6 months. There you go. It's not a bad chart, and I don't know why this is so off way here. These things should be lined up with this. And these should not be cyan, they should be purple. So I don't really use this. I'll tell you why. It's not as accurate as I want it to be. It's great because, I mean, one of the selling tools is it's also, I don't know why, but, oh, you can't see it. You got to put it on 2 years to see it. It's supposed to, oh, it's on NITIS, so that's probably why it doesn't do it. Let's try Apple. Hopefully that won't. Okay, you're supposed to be able to overlay earnings as well. There you go. And that's kind of a unique feature. Earnings overlaid on top of price, also showing projected puts and calls. It's the claim to fame to this chart. But I much prefer, if I wanted, for example, NITIS, and I wanted to go out in time, I'm simply going to add a study, and I've shown you guys this, probability of expiration cone. And I simply, it's always there, I'm just going to add the study now, and then click apply, okay, apply, okay. Now I have the same thing. It defaultly, this probability cone, defaultly when you add it, it's coming out the probability range is 68, but the period is, I've got it set for 77 days. Only because if you set it for too many days, this would end up being way over here. But all you're looking for is, you know, where's the probability based on price movement, high, low, open, close, projecting out on time, where's the probability of that to be? Now, next time, folks, I'm going to go much more into depth into Thinkorswim, and I'm preparing that for next session. So be prepared for a TOS lesson, okay? I'm going to show you guys how do you analyze, and you guys on all trades should be doing this. How do you analyze profit or loss, i.e. risk reward? That's key to trading on every trade. It's not hard to do. You need to look at a P&L graph, but understand what you're looking at. Okay? Like, I don't know, let's throw in NETS. I haven't added a simulated trade, so let's just throw something out there. Since this is a put we're looking to do, let's, I don't know. Sitting at 93, it's a $93 stock. So let's go out to, yeah, let's go out to here, 85. Okay, so we pay $1.45, which is about 1.5% on a $93 stock. So you've added the simulated trade. I'm sorry I'm going in a little bit of this, but now you're going to do this. You need to be able to understand profit or loss on this thing, you know, and know if you're moving the graph, what does that mean? You need to know what these hash marks are. What is this red line? What is this white line? Okay, this is a P&L graph, folks. You're going to know where your break even is as well. And that's an important part of learning, or, you know, especially calendar spreads or any directional trade. I mean, this happens to be a directional trade, but calendar spreads will look like a peak and a valley. You know, it peaks and it comes down, both these things. And you really want to look at that and to know where is your opportune price from the one you sold and the one you bought. Where are those opportune spots to where you want to be able to maximize your profit? And that way all you got to do is jot it down or put it on an Excel sheet. And you know when you're monitoring things, hey, where's my front month at? My far out anchor, where's that at? Ah, now I got the opportune profit. Boom. And you can either sell that front and then roll it into the next month, creating a diagonal, keeping that FAR month, and then keep that income stream going every month, in and out. But this is what I'm going to go over, as well as yeah, you see you have a spread hacker here. This is pretty cool. And in other words, you can do this end of day. I've got to reset all of this. All stocks, no scan for all. That's two, for example, verticals. Okay, there's verticals. I've already got these parameters preset. You know, what's the underlying price of the stock? What does it go up to maximum? What's the probability of profit? I put 80%. Why not? Right? You know, 80 to 100% profit. Or probability of profit. What's the max? 90 to, you know, whatever. And the volatility diff and back diff of volatility, I could explain that. These just have to be opposite of each other, that's all. And can you actually even get rid of that? And all you have to do is click scan. And it should populate. Can I set up put call? Can you set up put/call ratio on TOS? When you say put call ratio, Brian, explain a little bit more of what you mean. And then Bob says, restate the width of the channel on projection. Restate the width of the channel on projection. The width of this channel here, is that what you're talking about? You guys are going to have to type it in so I know what you're saying. Oh, okay. To show how many puts versus how many calls are active for the day. On best choice or TOS, Brian? Just type in BCS or TOS. TOS or BCS. Okay. I'll go back to you, Bob. That's really simple. Just look at volume. For example, Apple. There was 20,578 contracts bought or sold. That's the thing you don't know about volume. Now, we are on the call side, so we're assuming the preponderance is going to be of buying calls, not selling them. Very few people sell calls at the money. You're either doing it out of the money or in the money. So just look at volume. In other words, open interest indicates how many people have bought contracts and are holding them overnight. Volume is how many people bought or sold contracts today. Whenever you see that disparity difference, especially if it's 4 or 5 times the open interest, that's a major sign somebody knows something, and you may want to jump on board of that. Some people, that's all they look for, and have created programs to scan for volume versus open interest. That's on best choice. You can see the same thing on TOS on any particular stock. Here's GPRE. When you're looking at open interest and volume, you need to set your layout to see all of this stuff. And these are the important things, in my opinion, what you want to look at. Are people loading up? What is the volume of people that are buying or selling today? What's my IV, implied volatility? Is it high? Is it overpriced? How does that compare to historical volatility for the stock? You'll always see a run-up of volatility to an unknown event, like earnings. I want to see what my delta is. As I've taught everybody, my rule of thumb, I didn't get this from myself. This is from Dave McMullen out in California, who manages a $500 million hedge fund. This is his rule. Delta 0.20 or greater. He doesn't trade anything other than that, if it's lower than that. Theta, of course, is what is the time decay. So you subtract theta from delta to give your true net movement on your option based on a dollar movement of the stock. Okay? So you need to be able to set that layout properly. Okay, I see people starting to bounce off here. I've run over 10 minutes over this. Well, actually, I'm actually only an hour, 5 minutes in, so it's actually right on time. See, so you can look here, as you see in March, for example, this one, Brian, there's a lot of people loading up open interest on this side. Also, you got to make sure you look at the put side, too. Is there a disparity? Which means there's divergence. People really don't know what's going to happen. If you see a preponderance on one side or the other, then that's where the market and the general public is leaning. Hopefully that answers that question. Okay, as always, thanks for everything, guys. This is a neat chart. As I said, though, I like to use my my toss charts because, see, I can set these things out for further. And then I can compare them with Fibonacci retracements or extensions, and inevitably they're almost like this is $112.40. This projection for November is $112.90. You know, it ends up being such great confirmation to help you make trading decisions as well. So as far as projecting out in time, I prefer the probability cone. And Bob, the reason very simply is as well, and I'll finish up with this, is I can change this. As I said, I've got it set for the range of 77 days. I can set it for whatever I want, and these cones will extend out for 6 months, a year, 2 years, whatever. And so it's accomplishing with, in my opinion, more accurate because it's actually giving me that dollar amount figure, which unfortunately Best Choice does not do. I have to guess. Make sense? Okay. Come on, Bob, you got to say yes, it makes sense. All right. Again, I thank everybody for all their contribution to this, and hope you guys learn. And I want to wish everybody great trading. And until next week, have a great week, everybody.